Well, first-time home buyers have been priced out and sidelined for several years, but finally, some possible signs the market may be cooling off.
Mortgage rates are rising and real estate companies are issuing layoffs, but what does it mean for potential home buyers? In today's Consumer Watch, an expert weighs in.
Several signs showing a possible real estate cool down just as the market enters its hottest, busiest summer season.
This is when the largest majority of buyers are looking to buy, and in the real estate market, buyers drive the market.
The buying frenzy for those few available homes could soon be declining. According to Freddie Mac, mortgage rates increased by more than half a percentage point last week, the biggest one-week jump since 1987. The 30-year fixed-rate mortgage jumped to nearly 5.8% in the week ending June 16th. For comparison, rates were under 3% the same time last year. That makes homes even more expensive for those who need to take out a loan to buy, and that could lower demand.
The question on everybody's mind is, will these interest rate hikes slow the market down so much that prices drop? And unfortunately, the only way that that would happen is if it pushed enough buyers out of the market that the demand for the existing supply decreased. And that's not what we're seeing.
The average mortgage rate increase follows last week's Fed interest rate hike and major layoffs at 2 U.S. real estate companies. Redfin is cutting 8% of its staff as its stock is down 80% this year. And Compass laying off 10% of its staff, citing clear signals of slowing economic growth. So what does this all mean for first-time homebuyers?
Even though we've seen a rate hike, it's going to get even worse. So if you're waiting to buy real estate because you think it's unaffordable, it might become even more unaffordable as they continue to raise rates.
For today's Consumer Watch, I'm Jen Sullivan.